A sharp rise in tensions in the Middle East, mainly between the U.S. and Iran, have been pushing oil prices higher. And Washington has beefed up its military presence there and imposed tough new sanctions on Tehran, targeting its oil exports. Here to discuss the implications is Michael O'Brien. He's lead manager with Private Investment Council, Canadian Blue Chip Model, and Private Canadian Equity Fund at TD Asset Management. The news just keeps on going on. I mean, you saw the bulletins that non-emergency U.S. personnel are being asked to leave. I mean, there's a lot of nastiness, attacks on 4 oil tankers. What is? I mean, I know you don't have a crystal ball, but where do you see this playing into? Like, what should we be preparing for?
Yeah, well, I mean, the Middle East has always been a very difficult region, but clearly things are escalating a little bit quicker than most people would have anticipated. I think at the end of the day, it just puts a bit of a risk premium into the oil price. So whatever you thought the range for oil was going to be 2 weeks ago, I would say bump it up by a few dollars.
What do you see the range of oil right now?
I don't see it going a whole lot lower in the short term unless we get some really bad news on the trade front. Mm-hmm. Right now, the fundamentals, the supply and demand, seem to be pretty nicely balanced. And at the end of the day, it comes down to inventories. Inventories will tell you how tight the market is. Right now, it looks like inventories are set to draw.
The part of this, of course, and again, this is at the margin because Iran is not a huge supplier of oil in the world market, I'd say. But, we know that their output has basically been cut in half. And I think we have supply disruptions from Venezuela as well on top of that. The Saudis have said that they're not interested in increasing their output at this point. I mean, things can change. So we're seeing oil right now at about $62. You're saying you see that as a floor?
Well, I think it's a pretty solid price right now.
Yeah. Where could, I mean, any thoughts on where it could go from here?
Well, I think what's different now versus, 10, 15, 20 years ago is there is an ability for the industry to respond reasonably quickly. By reasonably quickly, I mean, 6, 9, 12 months, which is, the U.S. shale producers, if prices get to a level where they're, where they can't resist the temptation, then they will drill and they can increase production. It takes time. I think the more reasonable or more realistic path in terms of keeping that balance so that oil doesn't get too hot is really the OPEC producers themselves, and in particular Saudi Arabia. Yeah. Because to your point, Iran itself, the incremental oil coming out of, because of these sanctions, isn't an enormous part of a 100 million barrel a day oil market, but it is a meaningful part of the, the effective spare capacity that OPEC has. And that's where on the margin, that's where it really affects the price. So right now it's going to be dependent on Saudi and, potentially the Russians as to how much and when they let some of that oil back into the market.
It is, I guess, good news for those who are producing oil right now in terms of where the prices were. Take Canada. Good to have oil prices up. It's good for, it brings up WCS prices as well, but we're still faced with the same old, can't get it out.
Yes, well, in Canada, yes, it's been a great frustration, obviously, and you think about the potential. If we could, if we had a pipeline, there are a lot of places in the world that would love to get their hands on that oil. Yeah,
there's a look right now at the differential between WTI and WCS. A lot less than it used to be. Yep. Obviously, there's been some things put in place, but where do you see this playing out here in Canada? There's a lot of people I've talked to who said, look, we've missed the window, so to speak, on this because, by the time, this is a very big picture, by the time we actually can get oil to market and build a pipeline, the world may have transitioned into something else at that point, No?
No, I'm not in that camp at all.
Tell me more, why?
So, well, I think in terms of, the demand outlook, global demand has been very resilient for a long, long time. Huh. And so I think longer term, as in, decades from now, one day there will be peak oil, but I think that's a long way out in the future. In the here and now, I think the challenge for Canada is simply to get its oil to market, and specifically to Tidewater or to the U.S. Gulf Coast. Just as one example, so the heavy Canadian barrel today, the screen there, it's the differential is around $14 today. I think realistically that range should be 15 to 20. That would be a nice range for Canada. But just to give you a sense, a similar Mexican barrel that sells in the U.S. Gulf Coast today actually trades at $1.50 more than WTI. Wow. So $15 more than the same Canadian barrel.
Yeah.
It's just a question of access.
Yeah, blood pressure just went up in the west part of the
Yeah.
country when you said that, for sure. In terms of, you mentioned you see decades of demand coming from oil in the next little while.
Yep.
I'd say in the next 6 to 7 months, any concerns about China and just trade and what that's going to mean for oil demand?
Clearly, if you have the world's two economic heavyweights going at it with each other, that's not conducive for demand, clearly. It creates uncertainty, a lot of disruption. So on the margin, that can't be construed as a positive. So you want to hope that cooler heads prevail there.
Yeah. Great insights as always. Thanks so much.
Great, thank you.